Japan's bond market has long been treated as an anomaly, insulated by domestic savings, central bank intervention, and institutional patience. That assumption is now under strain. As policy shifts accelerate and yield controls weaken, the world's largest pool of low-cost capital is beginning to move in ways global markets are not prepared for. Japanese investors sit at the center of global bond demand, holding trillions in US Treasuries, European debt, and credit instruments built on the expectation of stable Japanese funding. As returns at home rise and currency dynamics shift, those flows are no longer guaranteed. This is not a localized adjustment. It is a pressure point for global liquidity, pricing, and risk transfer. What appears incremental is structurally destabilizing because the unwind of Japan's bond positioning does not require panic to cause damage. It only requires persistence. For more than 3 decades, Japan occupied a unique and stabilizing position within the global financial system. Its persistent low growth environment, deflationary pressures, and aggressive monetary accommodation created a structural surplus of domestic savings that could not find sufficient return at home. This surplus was exported through institutional capital flows into foreign sovereign bonds, corporate credit, and structured products, quietly anchoring global bond demand. Japanese insurers, pension funds, banks, and asset managers became among the most reliable buyers of long-duration debt issued by the United States and Europe, not because of tactical yield chasing, but because domestic alternatives were systematically suppressed. This dynamic hardened into an assumption embedded across global markets. Japan would remain a permanent exporter of capital, a predictable absorber of global debt, and a stabilizing force that dampened volatility even during periods of stress. That assumption is now eroding, and the timing makes it uniquely dangerous. The strategic importance of Japan's policy normalization lies not in the absolute level of yields, but in the signal that the era of enforced yield suppression is ending. As the Bank of Japan gradually retreats from rigid yield curve control and allows market forces greater influence over domestic bond pricing, the internal equilibrium of Japanese portfolios shifts. Institutions that once faced a binary choice between negligible domestic returns and foreign exposure with currency and political risk are now confronted with a third option: earning acceptable returns at home with lower volatility, regulatory familiarity, and reduced balance sheet complexity. Even incremental increases in Japanese government bond yields alter long-standing asset allocation models. Duration matching for life insurers becomes less reliant on foreign sovereigns. Pension funds recalibrate expected returns without extending currency exposure. Banks reassess liquidity management strategies that once treated foreign bonds as substitutes for domestic instruments. These changes occur quietly, through committees and quarterly rebalancing, rather than through dramatic liquidation, which is precisely why they are so easily underestimated. Historically, global bond markets have experienced shocks tied to issuance surges, inflation surprises, or abrupt policy tightening by major central banks. The present shift is different in character. It is a demand-side structural adjustment driven by the reorientation of one of the world's largest capital exporters. Japanese investors collectively hold trillions of dollars in foreign bonds, accumulated over years of suppressed domestic yields. The scale matters not because all of this capital will return home, but because marginal changes in allocation can have disproportionate effects in markets already saturated with supply. Governments in the United States and Europe are issuing debt at historically elevated levels to fund fiscal commitments made during periods when borrowing costs were assumed to remain structurally low. Corporate issuers, particularly in investment grade and leveraged credit markets, expanded balance sheets under similar assumptions. These debt loads are sustainable only if demand remains deep, price insensitive, and stable. Japanese demand has played that role. As it becomes conditional rather than automatic, the entire pricing structure of global bonds is forced to adjust. The mechanics of this adjustment operate through multiple channels simultaneously. Yield differentials are the most visible, but not the most decisive. Currency risk and hedging costs play an equally important role. For years, Japanese investors accepted low or even negative hedged yields on foreign bonds because domestic yields were worse. As Japanese yields rise, the opportunity cost of holding hedged foreign bonds increases sharply. The cost of currency hedging, influenced by interest rate differentials and swap markets, becomes more punitive when domestic rates are longer anchored at zero. This erodes the economic rationale for maintaining large foreign bond positions, even when headline foreign yields appear attractive. The result is not sudden selling, but persistent non reinvestment. Bonds mature, coupons are received, and proceeds are increasingly recycled domestically. This slow bleed tightens global markets in a way that issuance schedules cannot offset. Market pricing signals already reflect this transition, though not yet in a way that commands public attention. Yield curves in major economies are adjusting unevenly, with long end yields exhibiting stubborn resilience despite expectations of economic slowdown. This resilience is not solely a reflection of inflation risk or fiscal concerns, it is also a manifestation of waning structural demand. Volatility in bond markets remains elevated relative to pre pandemic norms, even in the absence of acute shocks, indicating that the buyer base has become more price sensitive. Term premiums, long suppressed by central bank intervention and foreign demand, are reemerging. These shifts are subtle but cumulative, and they expose a vulnerability in financial models that were calibrated to a world of abundant, patient capital. The policy constraints surrounding this transition compound its destabilizing potential. Japanese authorities cannot easily reverse normalization without undermining credibility or reigniting distortions that have already imposed significant costs on the domestic financial system. Years of yield suppression compressed bank margins, distorted asset pricing, and reduced the efficiency of capital allocation. Allowing yields to normalize is not merely a policy preference. It is a response to domestic inflation dynamics, currency pressure, and political realities. At the same time, US and European policymakers are constrained in their ability to offset rising yields without compromising inflation control or fiscal credibility. Coordinated intervention to stabilize bond markets risks being interpreted as fiscal dominance or monetization, especially in an environment of elevated public debt. The traditional safety valves are therefore less effective than in previous cycles. The global spillover effects extend beyond sovereign bonds into credit markets, equities, and emerging economies. Higher benchmark yields raise the discount rate applied across asset classes, compressing valuations and increasing refinancing risk. Credit spreads widen not because default risk has surged, but because the marginal buyer demands greater compensation for uncertainty. Emerging markets, which rely on stable global liquidity and predictable capital flows, face renewed pressure as developed market yields rise and capital becomes more selective. Currencies adjust, trade balances shift, and external financing costs increase. These effects feed back into developed markets through trade, financial exposure, and geopolitical alignment, reinforcing the sense that the adjustment is systemic rather than localized. What makes this moment particularly fragile is the degree of leverage and expectation built atop the old equilibrium. Global financial architecture has been optimized around the assumption of low volatility, abundant liquidity, and reliable cross border capital flows. Japan's role as a stabilizing exporter of capital was not merely a footnote, it was a foundational pillar that allowed other imbalances to persist. As that pillar weakens, the system does not collapse, but it becomes less forgiving. Shocks that might once have been absorbed now propagate more forcefully. Policy errors carry greater consequences. Market narratives lag behind structural change, creating a risk that adjustments are misunderstood until they become unavoidable. Looking ahead into 2025 and 2026, the trajectory suggests continued recalibration rather than resolution. Japanese yields are unlikely to surge uncontrollably, but they do not need to. Even modest normalization sustains the incentive for domestic retention of capital. Global bond markets must therefore adapt to a world where one of their most reliable sources of demand is conditional and price sensitive. Governments will face higher funding costs and greater scrutiny from investors. Corporations will encounter tighter financial conditions even in the absence of recession. The distribution of capital will increasingly reflect geopolitical alignment, regulatory compatibility, and perceived stability rather than purely yield differentials. The deeper implication is strategic. Financial power is exercised not only through policy decisions and sanctions, but through the structure of capital flows. Japan's normalization marks a transition from a world where stability was subsidized by suppressed yields to one where market discipline reasserts itself unevenly. This does not herald immediate crisis, but it does signify the end of a regime that supported unprecedented debt accumulation. Intelligence. Assessments should therefore treat Japan's policy shift not as a domestic adjustment, but as a global inflection point. The unwind will be slow, technical, and often misunderstood, but its cumulative impact on global financial stability will be profound. Currency dynamics now sit at the center of the global bond, unwind, because they directly determine whether Japanese capital continues to act as a stabilizing force or becomes a passive accelerant of tightening financial conditions. For decades, the outward flow of Japanese savings into foreign bond markets was not driven purely by nominal yield differentials, but by a carefully managed interaction between interest rates, currency hedging costs, regulatory capital treatment, and balance sheet stability. This system functioned smoothly when interest rate differentials were wide, the yen was structurally weak, and domestic yields were pinned near zero. That environment no longer exists. The ongoing normalization of Japanese monetary policy is altering currency mechanics in ways that amplify bond market stress far beyond what headline yield changes alone would suggest. This shift matters now because global bond markets are already operating with limited shock absorption capacity, elevated issuance needs, and investor sensitivity to volatility. Currency adjusted returns, not nominal yields, are becoming the decisive variable. At the core of this dynamic is the cost of hedging foreign bond exposure back into yen. Japanese insurers, pensions, and banks typically hedge a large portion of their foreign bond holdings to reduce currency volatility and protect regulatory capital. The cost of this hedge is determined by interest rate differentials and conditions in cross currency swap markets. When Japanese rates were anchored near zero and foreign rates were modestly higher, hedging costs were manageable, allowing institutions to capture incremental yield while maintaining currency stability. As Japanese yields rise and differentials narrow, the economics shift sharply. Hedging costs increase relative to expected returns, compressing or eliminating the yield advantage of holding foreign bonds. In many cases, fully hedged foreign bonds now offer returns comparable to, or even below, domestic Japanese government bonds. This represents a fundamental change in portfolio arithmetic that does not require any change in risk appetite to trigger reallocation. This repricing mechanism operates mechanically and predictably. As hedged returns deteriorate, institutions adjust marginal allocations. New investments are directed domestically rather than abroad. Maturing foreign bonds are not fully rolled over. Duration exposure is shortened to reduce volatility sensitivity. These decisions are made incrementally, through investment committees and asset liability management processes, rather than through forced selling. Yet the aggregate impact is significant because Japanese institutions operate at immense scale and with long time horizons. Even small percentage shifts in allocation translate into tens of billions of dollars in reduced demand for foreign sovereign and credit markets. In an environment where issuance remains heavy and other traditional buyers are more price sensitive, this marginal demand reduction exerts upward pressure on yields and widens risk premiums. Currency movements compound this effect in both directions. A strengthening yen reduces the incentive to hold foreign assets for return enhancement, as currency appreciation offsets yield gains and increases the opportunity cost of foreign exposure. This encourages further repatriation and reinforces domestic allocation. Conversely, a weakening yen raises imported inflation pressures within Japan, increasing political and economic pressure on the Bank of Japan to continue normalization. That, in turn, pushes domestic yields higher and further erodes the relative attractiveness of foreign bonds. In either scenario, the direction of adjustment destabilizes established flow patterns that global markets have relied upon for decades. There is no stable equilibrium that restores the old incentives without reintroducing distortions that Japanese policymakers are actively trying to unwind. The feedback loop between currency dynamics and bond pricing is subtle but persistent. Reduced Japanese demand weakens foreign bond prices, particularly at the long end, where duration sensitive buyers have historically played a critical role. Higher yields increase mark to market volatility, which feeds back into risk models and capital charges for global investors. This volatility discourages leveraged and duration heavy strategies, further thinning the buyer base. As liquidity conditions tighten, bid ask spreads widen and market depth deteriorates, making price discovery more abrupt. Currency hedging costs rise further as cross currency basis markets reflect increased demand for dollar funding relative to yen. Each of these steps reinforce ease the others, not through panic, but through rational risk management responses. Historical precedent suggests that currency driven capital flow reversals are among the most destabilizing forms of financial adjustment because they operate across borders and asset classes simultaneously. Previous episodes, such as the unwinding of yen carry trades or shifts in European bank dollar funding, demonstrate how quickly liquidity assumptions can break down when currency mechanics change. The current environment is more dangerous because global debt levels are significantly higher, balance sheets are more leveraged, and central banks have less room to intervene without undermining credibility. Unlike past episodes, where policy easing could restore incentives for cross border flows, today's constraints make such responses less effective and more politically contentious. Market behavior already reflects growing sensitivity to these dynamics. Yield movements increasingly diverge from domestic economic fundamentals, suggesting that flow driven adjustments are exerting influence. Volatility in currency and bond markets remains elevated even during periods of stable macro data, indicating that structural rebalancing, rather than cyclical news, is driving price action. Institutional investors are paying closer attention to hedged returns and currency basis signals, often reducing exposure preemptively rather than waiting for clearer narratives. This anticipatory behavior accelerates adjustment because markets move before public explanations coalesce, leaving policymakers and commentators reacting to outcomes rather than shaping expectations. Government and central bank constraints further amplify the impact of currency driven bond unwinds. Japanese authorities cannot easily suppress yields again without reintroducing the very distortions that normalization aims to correct. Doing so would risk weakening the yen, importing inflation, and damaging domestic financial institutions. Meanwhile, US and European policymakers face their own constraints. Aggressive intervention to cap yields could be interpreted as fiscal dominance, undermining confidence in inflation control and long term debt sustainability. Coordination across jurisdictions is politically fraught and operationally complex, particularly when the adjustment is driven by private sector portfolio decisions rather than overt policy shocks. The result is a vacuum in which market forces dominate, even when their outcomes are destabilizing. The global spillover effects are uneven but cumulative. Higher yields in core markets tighten financial conditions globally, raising borrowing costs for sovereigns, corporates, and households. Emerging markets face renewed pressure as capital becomes more selective and dollar funding costs rise. Currency volatility complicates trade and investment planning, particularly for economies with high external financing needs. Financial institutions with exposure to long duration assets face balance sheet strain, prompting deleveraging that further reduces market liquidity. These effects feed back into developed markets through trade linkages, financial exposure, and confidence channels, reinforcing the sense that the adjustment is systemic rather than localized. Looking forward into 2025 and 2026, the trajectory suggests that currency dynamics will remain a key amplifier of bond market stress. Even if Japanese normalization proceeds cautiously, the direction of travel is clear enough to sustain reallocation incentives. Hedging costs are unlikely to return to levels that made foreign bonds structurally attractive without significant changes in global rate differentials. Currency volatility will persist as markets test new equilibria, and institutional investors will continue to prioritize balance sheet stability over incremental yield. This implies a prolonged period of higher term premiums, reduced liquidity, and greater sensitivity to shocks across global bond markets. The strategic implication is that currency adjusted capital flows are no longer a passive background condition, but an active driver of global financial stability. The unwinding of assumptions around Japanese demand exposes how deeply integrated currency mechanics are with bond pricing and liquidity. Intelligence assessments should therefore treat currency dynamics not as a secondary variable, but as a central transmission channel through which structural change propagates. The adjustment does not require dramatic events or headline grabbing sell offs. Incremental decisions by large, patient institutions are sufficient to reshape equilibrium. In a world already strained by high debt and geopolitical fragmentation, that slow, relentless pressure may prove more consequential than any single crisis trigger. The current vulnerability of the global financial system cannot be understood without recognizing how deeply leverage was constructed on the assumption of stable bond correlate. ions, and persistently low volatility. For more than 2 decades, global markets operated within a regime where sovereign bonds, particularly those issued by advanced economies, behaved in predictable ways. Yield movements were gradual, correlations across maturities and geographies were stable, and volatility spikes were episodic rather than structural. This environment allowed leverage to accumulate quietly across governments, financial institutions, asset managers, and derivatives markets. Japan's bond market, anchored by decades of yield suppression and extraordinary central bank intervention, functioned as a silent stabilizer within the system. It provided a low volatility reference point that reinforced confidence in duration heavy strategies and cross market hedging models. That stabilizing role is now eroding, and its disappearance exposes how much of the global financial architecture was built on assumptions that no longer hold. The importance of this shift lies not in any single policy decision or market event, but in the transition from a regime of stable correlations to one of fragmentation and persistence in volatility. Leverage thrives when asset relationships are predictable. When sovereign bonds reliably hedge risk assets, when yield curves move in tandem, and when currency adjusted returns can be modeled with confidence, balance sheets expand naturally. Governments issue more debt because funding costs are manageable. Financial institutions extend duration and maturity mismatches because volatility appears contained. Asset managers employ leverage and derivatives because historical correlations suggest diversification will hold under stress. Japan's role in this system was understated but critical. Its suppressed yields anchored global term premiums and reinforced the perception that large sovereign bond markets could be insulated indefinitely from inflation, demographic pressures, or policy normalization. Historically, periods of financial instability often followed moments when such assumptions quietly unraveled rather than collapsed overnight. The late 1970s exposed the fragility of bond markets, built on the belief that inflation was permanently subdued. The early 1990s challenged confidence in fixed exchange rate regimes that had underpinned cross border capital flows. Global financial crisis revealed the dangers of assuming housing prices and credit correlations would remain stable. The current moment shares a common feature with those episodes, but differs in scale and complexity. Today's system is more leveraged, more interconnected, and more dependent on market based finance rather than regulated banking. Bond markets are larger relative to economic output, derivatives exposures are more deeply embedded, and sovereign balance sheets are far more stretched. This makes the breakdown of correlation assumptions more dangerous because there is less margin for error and fewer credible backstops. At a mechanical level, the problem begins with the recalibration of risk models. Value at risk frameworks, stress tests, and asset liability management systems rely heavily on historical relationships between assets. When correlations shift unevenly, these models lose predictive power. A rise in yields in one market is no longer offset by stability elsewhere. Duration hedges fail to perform as expected. Funding costs rise faster than anticipated. Volatility does not need to spike sharply to cause damage. It only needs to remain elevated long enough to force adjustments. Persistent volatility erodes carry trades, compresses leverage, and increases margin requirements. Over time, this creates a slow but relentless tightening of financial conditions that is difficult to reverse. Governments feel this pressure directly through higher debt service costs. Years of low yields encouraged fiscal expansion and deferred consolidation. As yields rise unevenly across maturities and jurisdictions, refinancing becomes more expensive and less predictable. Fiscal space narrows not because of immediate crisis, but because interest expenditures crowd out other priorities. This dynamic is particularly challenging for advanced economies with aging populations and rigid spending commitments. Political constraints limit the ability to adjust taxes or cut spending, while monetary authorities are constrained by inflation credibility. The result is a gradual erosion of fiscal flexibility that weakens confidence and raises risk premiums further. Credit markets transmit this stress outward. Corporate borrowers face higher benchmark rates and wider spreads as investors demand compensation for volatility and uncertainty. Structured credit products, which rely on stable correlations and low default assumptions, become more fragile as refinancing risks increase. Private credit, leveraged loans, and high yield bonds are especially exposed because their growth was predicated on the availability of cheap, predictable funding. As correlations break down, Investors reassess the diversification benefits of these assets, reducing allocations and shortening duration. This does not produce a sudden collapse, but it does create a sustained drag on investment and risk taking. Emerging markets experience the effects more acutely. Capital flows that once sought yield in a low volatility environment become more selective and cautious. Higher global yields raise the opportunity cost of holding emerging market assets, while currency volatility increases hedging costs. Countries with high external financing needs face renewed pressure, even if domestic fundamentals have not deteriorated significantly. The spillovers are amplified by the fact that emerging markets often lack deep domestic bond markets capable of absorbing shocks. As a result, global leverage unwinds disproportionately at the periphery, reinforcing asymmetries in the international financial system. The danger in this environment lies in misinterpretation. Because there is no single shock or dramatic failure, the adjustment can be mistaken for normal market fluctuation. Policymakers may underestimate the cumulative impact of persistent volatility and incremental yield increases. Market participants may delay de-risking in the hope that conditions will normalize. Yet history suggests that drawn-out unwinds are often more damaging than sudden crises because they sap confidence gradually and limit the effectiveness of reactive policy measures. By the time stress becomes visible in headline indicators, leverage has already been reduced in disorderly ways, and recovery becomes more difficult. Japan's shifting role crystallizes this risk. Its bond market is no longer a static anchor but an active source of variability. As yields adjust and correlations shift, global portfolios must be rebalanced. This forces recognition that the previous equilibrium was not sustainable. The adjustment process is inherently costly because it requires repricing assets, reallocating capital, and rebuilding risk frameworks. There is no return to the old regime without reintroducing distortions that policymakers are unwilling or unable to sustain. Looking ahead, the persistence of these dynamics into 2025 and 2026 suggests that global financial stability will depend less on crisis management and more on adaptation to a new regime. Leverage will be constrained by higher volatility and less reliable correlations. Funding costs will remain sensitive to policy signals and currency movements. Growth will be shaped by the ability of economies to absorb higher debt service burdens without sacrificing investment. The global system will not collapse, but it will operate with less tolerance for imbalance and error. The analytical conclusion is that the vulnerability of the global system stems not from a single policy shift, but from the gradual failure of assumptions that underpinned leverage across markets. Stable bond correlations were treated as structural features rather than contingent outcomes of extraordinary policy. As those correlations break down, adjustment becomes unavoidable. The cost of that adjustment will be measured not in dramatic crashes, but in slower growth, tighter financial conditions, and reduced resilience. Recognizing this reality early is essential because delay only increases the eventual price of adaptation.